Welcome, everyone. We are privileged to be joined by two truly great investors today. I'll start the conversation with Sir Chris Hohn, and we will later then be joined by Christian Sinding, CEO of EQT. Chris, it's a privilege and honor to have you. Welcome. I have to say I completely agree with Nikolai, probably the best investor Europe has ever seen. To back it up with numbers, 9% returns above the market every single year over a period of 21 years. Wow.
On average. Not every single year, but on average.
On average. So, share your secret with us.
Well, our strategy has been to invest in great companies, but over time I've come to refine and understand better what that means. And a lot of, but that's just point one, find the great companies. Point two is being concentrated. As George Soros said once, it doesn't matter if you're right or wrong, all that matters is how big you are, your position size when you're right and your position size when you're wrong. Yeah, if I'm right on a 1% position, it kind of doesn't make any difference. So we'll take positions of 10 to 15%, in the past even 25% of the fund. And that's a double-edged sword. If you're right, it's fantastic. If you're wrong, it's very painful. So concentration is an important facet, because there aren't hundreds of great ideas and companies, and you might say, that sounds risky. Then it is, and I would look at and ask you, well, how do you define risk? And the best definition of that was, for me, given by Warren Buffett, who we all love, and he defined risk as not knowing what you're doing. Now, there are a lot of investors, and then the third component, I would say, is long-termism. Mm-hmm. Yeah, you can find a great company, but if your time horizon is, very short, you're at the vagaries of what Keynes called the voting machine. He said in the short term the market is a voting machine, and only in the long term is it a weighing machine. And going back to Warren Buffett, he was asked, was Coca-Cola a risky investment when you first made it? And he said, depend on the time horizon. Over 1 year, 1 month, very risky. Mm-hmm. He couldn't tell where the price would trade at. It doesn't necessarily reflect fundamentals in any short or even medium term. And so I do think time horizon is a critical thing, and even intelligent investors are unable or unwilling to have a long-term horizon. And I would put engagement as another component of that for us, of adding value. So those, and so so find the great companies, focused or concentrated portfolio, long-termism, and engagement. Act as an owner, in simple terms. Mm-hmm. But a lot of investors get confused that the thing that you want is growth.
Yeah.
Yeah. And if you look at industries like airlines, they've been growing for 100 years, maybe 5% a year, fantastic growth, but collectively and cumulatively, the industry never made any money because competition was too strong. And so growth, per se, growth by itself is not a guarantee of making money. So you need critically barriers to entry to competition, mm-hmm. and sustainable value add and high value add, so that So it's actually a combination of barriers to entry and high value added that you can charge for, and of course then growth has a value. So everybody would agree with those statements, but the interesting thing is, going back again, third time to Warren Buffett, he said most moats aren't worth a damn. Because you think you've got a moat, and then it erodes. And so the real thing is sustainability of moats.
So how do you find out whether a great company remains a great company over time?
Yeah. Well, one of the things is to understand the forces of competition and substitution and disruption are very powerful. And we've learned, just as in the same way people underestimate complexity structurally, most investors underestimate the forces of competition and disruption. Why? Because they're short term. It keeps going back to the same root causes. And so we learn through examples and through sometimes experience and suffering. One of my investments 30 years ago, before I started TCI, was with a European media company that Bain Capital had bought control of, and it was a monopoly, and they bought it control. There was like €1 billion valuation, and the stock went to a 50 billion valuation, from 1 billion to 50 billion, and then it went to zero. And it was a Yellow Pages company in Italy. Because the internet hadn't been found, people thought it was a resilient monopoly, but Google destroyed the company. So we sometimes don't know. Yeah, we can't know what hasn't been invented. So then, how can you know anything? You might say. Yeah, it was Cheney who said, "Yeah, unknown unknowns. You don't know what you don't know." But but certain industries are more prone to disruption than others. Your risk is much higher, and so we try to avoid those sectors because you're asking for trouble or limit our exposure. And one of those sectors is technology.
Yeah. So what are the ones you like?
I've always liked, as one example, infrastructure, where which is a bit unusual, it's not that sexy, it's a bit boring, owning toll roads and airports and transmission lines, cell phone towers, but I was born into a poor family, and so I always wanted to get my capital back. I thought that was a good starting point. Don't lose your capital. And so I sort of believed in physical asset backing, which most investors don't look at tangible book value. That's something, forgotten in economic textbooks as a metric, or a placement value. But an example is maybe 9 years ago, the Spanish government approached us and about taking an anchor position in an IPO of their airport, AENA. And airport was basically brand new, huge under capacity, and 75% of the value was in unregulated shops and car parks and complete monopoly, unregulated, and huge growth potential. And they sold it at a 15% free cash flow yield. And what we could see is that you could never replace these assets, Madrid Airport and Barcelona Airport, and irreplaceable. And And they sold at the right price. Valuation matters. They sold at
Yeah.
a 15% free cash flow yield. And
So I learned at school that a great company is not necessarily a great investment. But you look at something like cash flow yield to tell you now it's a good time to buy.
And sometimes people say things are cheap for a reason. Now, people were concerned about government ownership in this case, regulation, and the government did impact it. They limited the compensation of the CEO to 200,000 euros. And ultimately, the CEO left. He was a very good CEO, the original. And so, but it didn't matter because the monopoly was there, the assets were there. So I like asset backing of infrastructure. Another sector that we've...
Can I just ask you one question on this? If you like an asset, the physical asset, does management quality matter? Is it important?
Less so. It matters for reinvestment risk. But one of the things I mentioned that we do is we act as owners. People have different terms for that, constructivists and activists, but I really think fundamentally it's acting as an owner. And in the case of, we were worried we didn't have any control, but we had influence. I was asked to be on the board. I was on the board for 3 years of AENA, the airport company, and we went to the government and to the board and said, look, you're throwing out for all this cash flow, billions of euros of cash. You don't need it. We want to propose an 80% dividend payout ratio. And for you, that's dividends you can spend, and they agreed to it. And so my reinvestment risk of management was limited then, very limited. And so there are things you can do to mitigate risk. But it does matter, another infrastructure asset we've been invested in is in the toll road sector in Ferrovial, where there's a family that have about a quarter of the stake, and they're fantastic capital allocators. They just reinvest. They sold Heathrow Airport recently, at a low return, and they're reinvesting in monopoly toll roads at high returns, and they just really know their business and have high alignment of interest. So, but again, Buffett said you've got to. Ideally, you should invest in an industry where a monkey could run it, because one day they will. And so, I want to find an asset where, because there's no guarantee the CEO comes back. Yep. And so, I think you have to invest in a business where it's a great business and it doesn't depend on the manager, because there's no, the assets are ultimately more reliable than the manager. So, so in this sort of where are the moats? We talked about infrastructure and physical, non-replicable assets. Another space we like, as an example, is aerospace. Things like aircraft engines and manufacturers like GE Aerospace and Safran. And we like that space because the barriers to entry are extremely high in terms of intellectual property. It's so complicated to make this product that there have been no new entrants for 50 years. So new entrants is a sign of the barriers to entry. It's one of the criteria you can look at. And why is that? And not only is it very complicated, you make the money in the spare parts. So once you've got this installed base, the new engines are only a small percentage, and the airframers only want 1 or 2 engines. It's too complicated otherwise. There isn't the room for multiple competitors. And then for various reasons, it's very difficult for competitors to enter the replacement parts. And so the switching costs, so that's another space where very intellectual property can be of a barrier.
Fascinating.